I want to bring in Lindsey Piegza now. She is chief economist at Stifel. So Lindsey, let's paint this picture for a moment. We've got rising COVID cases. We've got unemployment claims continuing to rise. We have retail sales, we found out today, weak for the second consecutive month. Should the Fed have moved more aggressively now? Because when you think about their next meeting at the end of January, most of the damage to this economy may have already been done.
No, I think the Fed actually was very anticipatory of lingering weakness because of the virus. And they took very aggressive, unprecedented actions early on to help stem that weakness right away. And maintaining these programs will continue to provide support to the economy. So I don't necessarily think they needed to initiate new programs, but it is very important that they keep these programs in place to continue to provide support to the U.S. economy as we continue to see more cases, more restrictions, more job layoffs, further weakness in the consumer. And now, one other thing is that the Fed, while keeping these policies in place, has been very vocal of handing over the baton to the federal government now to step up. I do expect that we'll hear further comments from the chairman in the press conference underway here in just a few minutes, really emphasizing the need for further fiscal support, essentially saying the Federal Reserve has done everything they can to support the economy to ensure a smooth functioning of the markets. Now it's up to our officials in Washington to continue to provide that artificial support needed at the individual and business level.
Lindsey, hey, it's great to see you. Jay Powell hasn't really veered. Back in November, he said that the program is delivering about the right amount of accommodation and support for markets, and so it continues. But the reporters are going to try and pin him down on this issue of what they purchase, the assets that they purchase, and the duration of those assets. And Brian was just saying there's no need right now to actually be purchasing, say, the 10-year or the 30-year. Do you see that? Is there a trigger we should look for as investors that would signal that the Fed's about to do that?
Oh, I don't think it's that easy. I don't think there's one specific trigger, but I do think that the Fed is going to continue to keep its options open. And Powell is likely to be very vague in his response to any type of questions around that, suggesting that the Fed very much could keep purchases at the current level, but simply extend the duration or ramp up purchases altogether. So by reiterating the fact that the Fed is willing to do either of those, what they're trying to do is really reinstate confidence in the market without even having to change the current securities program. So again, the Fed is going to keep the door wide open on further support, but being very vague, very uncommittal in terms of what they will actually do, what eventual changes we can expect as we turn the corner into the new year, where we will expectedly see further weakness in the domestic economy.
Lindsey, you brought up stimulus a moment ago. What does easing by the Fed alongside stimulus do to the U.S. dollar, to the inflation picture in 2021?
Well, in 2021, I don't think it does much. Right now, inflation is not a near-term concern. Now, certainly when we talk about the federal government pumping in trillions of dollars, there's generally an inflationary concern down the line. But at this point, I do think that a very tepid recovery marred by persistently elevated level of joblessness as well as a weak consumer is going to trump that increase in money supply. So essentially a weakness in the velocity of money component offsetting that increase in the money supply. Now, long term, I do think there are inflationary implications, particularly if we continue to see a ramp up in debt and deficits, not offset by any type of tax increases or spending cuts on the federal government side. But right now, near term, the Fed is not concerned about any inflationary concerns, as they really have struggled to get inflation back to their 2% target for the better part of the past decade. And in fact, now with a more flexible approach to inflation, with a headline PCE running about 1.3% since 2015, the Fed could essentially allow inflation to reach 3% for the next 5 years and still not exceed that longer term average of 2%. So there's plenty of leeway, plenty of wiggle room for the Fed to allow prices to increase, which will give them even more leeway or runway to keep rates at extremely low levels for quite some time.
All right, Lindsey Piegza, chief economist at Stifel, thank you.